Good morning, this is Ross Norman of Sharps Pixley London. In recent days we wrote that we felt that gold was due a period of consolidation, be healthy, or technically it would be healthy, on the basis that the market had rallied to record highs of $1,813 an ounce before coming off sharply in the wake of news that the long-term US debt had lost its AAA rated status, and indeed the ECB had been in to buy Italian and Spanish bonds, which are nearing the critical 7% level, which could have, it's kind of felt that the market was on the edge of a financial meltdown, to be perfectly frank, and gold responded by reaching those record highs. In the wake of that news, gold has come off down to the 1740 levels, and we felt that a period of consolidation around that level would be healthy before moving higher again in the fourth quarter of this year. It hasn't been that way at all. We were wrong. Gold's moved up already, and it's currently nudging $1,795, nearly $20, just $20 below the record high. What does that tell us about the market? Well, the move to record highs, I think, suggests that the market is impatient for long-term and sustainable economic policies from the politicians to solve the problems of these deeply indebted nations. They've bought time with these recent policies, but time is against them. So the move higher is suggestive that there's an element of impatience here amongst traders to see changes made by politicians who seem to lack the courage, should we say, to make decisions to give us what we need as opposed to what we really want. Talking of technically, well, we say that gold is overbought. What says who? Well, on 3 occasions in the last 4 years, gold has moved to 20% above its long-term trend line. When I say long-term trend line, we're talking about a 30-week trend line. On the first occasion, that was back in March 2008, gold went above, it came back to the trend line. December 2009 again, we saw that move, and it again quickly reverted to its mean. Today we're there again, with 21% above the long-term trend line, so technically it should move higher. The Bollinger Bands are another, again, a very valuable guide to whether the market is overbought or not, and again we're above the upper level of those bands, suggesting the market's overbought, and a retracement back to the 1750s or even 1730s is warranted. But we haven't had that, and I think it's suggestive of the head of steam that's behind this market. So the possibility of a move into bubble territory is on the cards. We're not there yet, but it's on the cards. A final point, if I can, there is an unusual guide to the gold market that we look at informally, it's an unusual one, and it relates to the hit rates to our site www.sharpspixley.com. We see accelerations in hit rates which seem to precede interest in buying physical gold. It seems to be a prescient indicator of appetite for gold. We're seeing a phenomenal number of hits on our site above the average, suggesting again to us that there's a momentum and a head of steam behind physical buying, which could well take us to record highs. In short, our view is that we will see gold at a record high again in the next short few days of 1813. Probably Friday. We seem to see the big moves on a Friday, so let's wait and see. Gold looking good, off to the races again, no time for a break. This has been Ross Norman at Sharps Pixley London. Thank you.